Income Tax 2020 Residential Rental Property Introduction. Come in, relax with Income Tax 2020. Residential Rental Property Introduction. With regards to the income tax formula, we're basically up top again in our top line item, remembering, however, that there's going to be a separate schedule, typically that being the Schedule E, which is similar to the Schedule C we saw in the past, in that we, in essence, have another income statement having both income and expenses generally on it. In essence, the net income of the Schedule E then rolling into the top line of our income tax formula, where we would then apply out our above the line and below the line deductions to get down to our taxable income. Here's going to be an example of the 1040. The Schedule E, in essence, rolling into the 1040 here on line 20. That's going to be coming from other income from Schedule 1, which would ultimately then be coming from the Schedule E. So here's just a quick example of the Schedule E. We'll take a look at it in more detail in future presentations when we work with the actual tax forms and tax software for some examples in the future, but just to get an idea of it, this is the first half of it, a Schedule E supplemental income and loss. And here's basically the second component of it. You can see it's, in essence, another kind of income statement similar to a Schedule C, but we have some specific requirements for rental type of property and therefore different schedule related to it. Now note that although the 2020 forms are out for the Schedule E, some of the information, including the publication 527, as well as the instructions for Schedule E, are still at the 2019 at this point. So we're going to push forward with it. We're going to pull the 2019 information from these resources, make adjustments where we think applicable, but just realize that most of this information is coming from the 2019 information. You can look this stuff up in the IRS website at irs.gov, irs.gov, and then search publication 527, search for the Schedule E instructions. 2020 information should be out shortly. There's a couple things we want to keep in the back of our minds when we think about the rental property that are going to be a little bit different than a Schedule C type of business. One is whether or not we use the rental property for personal use and for the rental property use. So if we have it for personal use and we use it for rental property, that's going to complicate things in terms of how we're going to allocate the expenses and whatnot related to the rental property versus the personal usage of it. If it's fully used for rental property, then that should make that component a little bit easier. Also, there's this concept of passive activity income, and passive activity income is basically the idea is it's applied to the type of property when the owner is not basically kind of like actively involved. It's not basically your principal business, or you're not actively involved in the business. It's kind of passive activity, and that could limit or change the way the taxes are going to be applied to it, especially if there's going to be losses. So oftentimes people that have rental property may have losses that they're trying to be taking against other type of income. The IRS is going to be basically kind of skeptical of that, and they apply these passive activity rules that we have to keep in mind, especially in the case when we have, say, losses on the rental property. Another type of thing that often happens when you're looking into rental property is whether or not the rental property is being used by a relative. So if you have a related party type of transaction for the rental property, once again, that can be a complication in terms of how you got to deal with it for taxes. So those are just a couple things to keep in the back of your mind as we go through the rental property that kind of differentiate it in some ways from just a normal type of business, which you would just basically report it in a similar way as you would for a Schedule C. In essence, taking the income statement for the rental property, putting it on a separate schedule, pulling that net income to the page 1 of the 1040, and so on and so forth. Just what is the rental income and expense if no personal use of the dwelling? So we're talking about a situation where we don't have personal use of the dwelling. This chapter discusses the various types of rental income and expenses for residential rental activity with no personal use of the dwelling. Generally, each year you will report all income and deduct all out-of-pocket expenses in full, as compared to if you had to allocate between, say, personal use and the property use for the rental property. So if it's fully used for rental, that makes that part a little bit easier. The deduction to recover cost of your rental property depreciation is taken over a prescribed number of years and is discussed in Chapter 2, Depreciation of Rental Property. So when you have rental property, if you're renting like a home or something like that, the actual cost of the home is, of course, a huge item. We can't just expense the cost of the home, kind of like its equipment and whatnot. Similar process. We have to put it on the books as an asset, and then we have to depreciate the building. Could possibly be depreciable as opposed to the land portion, and then we would have to depreciate over the useful life, which would be prescribed by the code, meaning the type of property will determine what type of depreciation method typically we will have access to, and then we can allocate the depreciation as an expense, and that's typically going to be a major expense oftentimes for rental property. So rental income, in most cases, you must include in your gross income all amounts you receive as rent. Rental income is any payment you receive for the use or occupation of property. So obviously, if you rent property, you're going to be receiving generally rent, and that's going to be the rental income. So it isn't limited to amounts you receive as normal rental payments. So basically, any cash that you're receiving or anything that you are receiving with relation to the rental, generally, for the general rule, would need to be in basically rental income. So if we have a cash method, now we have the cash method and accrual method we have to think about as we thought about with regards to the Schedule C type of business. Cash method, you are a cash basis taxpayer if you report income on your return in the year you actually or constructively receive it, regardless of when it was earned. So in other words, if you got like a prepayment or something like that and you received the cash and you record the cash as income at that point in time, then you're basically on a cash method, as opposed to if you receive, say, a prepayment and you didn't record it as income until the point in time that the income was earned, meaning the person actually used the place in order to then consume the revenue that was earned. You have to provide the rental service for the period of time covered in order to report the income. So you constructively received income when it is made available to you, for example, by being credited to your bank account. So constructively, we talked a little bit about that before as well. So obviously if it's in your bank account, then you've constructively received it, and you typically cannot do things like keep the check in the mail so that you can say that you didn't get it until January of next year or something like that, when it's in your mailbox or something like that, just because you didn't put it into the bank. In other words, doesn't mean you haven't constructively received it. So then we have the accrual method. If you are an accrual method taxpayer, you generally report income when you earn it rather than when you receive it. You generally deduct your expenses when you incur them rather than when you pay them. So on the accrual method, basically then we would be reporting income when we earned it. So if we got a prepayment, for example, then we wouldn't record it until the rental property was used for rental before we would record it at that point. Note that for the rental property, we don't have that restriction to cash when we use like inventory as we do with the Schedule C. You'll recall that if we had a substantial amount of inventory, say for a Schedule C, then the IRS is going to say, hey, I want you to use an accrual method because you basically should be tracking that on an accrual basis, the inventory. Since we don't have inventory, we don't have that same kind of restriction with the rental property as to the choice of cash and accrual. So rental expenses, in most cases, the expenses of renting your property, such as maintenance, insurance, taxes, and interest, can be deducted from your rental income. So obviously, these are going to be types of things that you would think would be deductible, given the fact that they're basically ordinary and necessary in essence, meaning that any kind of gross revenue that you're getting, if we're talking about an income tax, then we should be able to deduct as basically business expenses or rental expenses here, those types of things that we had to consume in order to generate that rental income. It doesn't seem fair, in other words, to be taxing us on gross income as opposed to the net income after we have spent the things that we needed to spend in order to generate the income, because that would favor certain types of industries over the other. So that's kind of the general rule for deductions in general. And again, it's most well seen when you're talking about business type of activities like rental property or Schedule C type of businesses. Personal use of rental property. If you sometimes use your rental property for personal purposes, you must divide your expenses between rental and personal use. So obviously, if we have the personal use then of the property, then whatever expenses we're allocating to the property, we got to make sure that we allocate properly between the amount that we're going to be deducting for business use and the amount that is personal, which typically we cannot possibly deduct or most likely not able to deduct there. So also, your rental expenses deduction may be limited. See Chapter 5, Personal Use of Dwelling Unit, including vacation home. So in other words, just want to recap on this. If it's personal use, then again, you might be able to, put it somewhere else on, say, like a Schedule A deduction or something like for personal or certain types of personal expenses. But the concept here, of course, being you can't really deduct it on Schedule E if you're talking about expenses that are not related to the rental property. So then we have the part interest. So if you own a part interest in rental property, you can deduct the expenses you paid according to your percentage of ownership. So then we have the types of expenses listed below are the most common rental expenses. Now, obviously, whatever, again, the general concept here being that the things that you had to consume in order to generate the revenue would be the types of things that you can deduct for an expense. But given the fact that you're talking rental property and that industry is somewhat standardized, you would think you would see the normal kind of expenses. So these are the categories that they would typically fall into. And when you're doing rental property kind of income taxes, these are the things that you would expect basically to see. And you might be asking about if there's anything unusual about it. So say like advertising, auto and travel expenses. So we have that same kind of issue with the auto and travel, which can be a little bit of a messy situation as we saw with the Schedule C. Cleaning and maintenance, of course, commissions, depreciation is going to be a big one, insurance a big one, interest, legal and other professional fees, local transportation expenses. So we got that transportation again, can be a little bit messy to figure that out, but we have that there, of course. The management fees, so we might hire a management company to help us or we might do more of the management basically ourselves. Obviously, if we hire a management company, then we've got those management fees, the mortgage interest paid to the banks, etc. So if we have a loan on, just like if we had a loan on the house, we got a loan on the rental property. So we would then have the interest related to it. Because that interest now is not on our personal residence, but it's on business property, then the interest you would think would be deductible because you're using that in order to help you to generate the revenue for the rental income property. So points, same kind of principle, rental payments, repairs that you have, taxes that would be applicable. Obviously, when you're talking about taxes, you're not talking about the federal income tax generally. You're talking about other state and local taxes generally applied to the homes, such as property taxes that may be deductible there. And then we have the utilities. So reporting rental income, expenses, and losses. Figuring the net income or loss for a residential rental activity may involve more than just listing the income and deductions on Schedule E, Form 1040 or 1040-SR. There are activities that don't qualify to use Schedule E, such as when the activity isn't engaged in to make a profit or when you provide substantial services in conjunction with the property. So these are situations which would add a little bit of complexity. If you're providing substantial services, then maybe it shouldn't be a Schedule E type of activity, but possibly a Schedule C type of activity, a normal type of business activity. And if you're engaging it not in it for profit, if it's something that's not for profit, then you might not be using a Schedule E, or in other words, you might have it for profit that's going to be just capital gains. You might just simply be holding on to the property, hoping it goes up in value and not using it as the rental property in essence. And in that case, maybe you wouldn't be using then the Schedule E, but you'd be holding on to it basically as investment property in that case rather than rental property. And that could mean that you're not going to be using the Schedule E in those cases. So if you have the Schedule E for the rental property, then you want to make sure that you can show that you are using it basically as the rental property. There are also limitations that may need to be applied if you have a net loss on Schedule E. So this is that situation now that IRS is skeptical of losses, especially on the Schedule E, because the Schedule E losses, one, they can be substantial because you're dealing with rental property. They also apply typically to higher income individuals, so you're typically talking about larger dollar amounts. And the losses then could be taken against income in other areas. Also, when you're talking about rental property, oftentimes there's two things people want from the rental property. One is they're holding onto it for an investment, meaning they're hoping that the property itself goes up in value just in terms of appreciation in the value. And two, you can do the rental of it. So if people then have the rental property, you can imagine a situation where they're actually taking losses from the rental income, writing off the maintenance of the property, but keeping up the property itself as they do so. And then actually the value of the property is going up and they're getting a gain on the value of the property going up. And then when they sell it, they'll have that capital gain. So there's kind of two things that are taking place with the rental property. Then typically you got the rental income and then you've got the value of the property. So again, the IRS is going to be skeptical then of the losses that people are taking against other property. And that's where you got these passive activity rules that will come into play. So anytime the rental property goes into a loss, then the IRS is of course more concerned about these taking the losses. So there are two. One, the limitation based on the amount of investment you have at risk in your rental activity, and two, the special limitations imposed on passive activities. So you may also have a gain or loss related to your rental property from a casualty or theft. This is considered separately from the income and expense information you report on a Schedule E. So then we have the qualified joint venture. If you and your spouse each materially participate, so now we have two individuals, you'll remember that we saw this on a Schedule C as well. So if you're taxpayers that are married, then of course, now you've got two individuals, but the tax for taxes, you're kind of seeing as like one entity. So what if those two individuals now have a kind of like a business, this time being a rental property where they both materially participate in it? Normally, if they were not married, you'd have a partnership type of situation, which would be more complex because then you'd have to file a 1065 form and then issue the K-1s to the two partners. And then the two partners would have to report the income from the K-1s. But in this case, they're both reporting on the same 1040, so that seems like you shouldn't kind of have to do that. So that's going to be a similar situation that we saw with the Schedule C. So if you and your spouse each materially participate, and you can check out material participation under passive activity rules, and you can see that on the publication, as the only members of a jointly owned and operated real estate business, you may file a joint return for the tax year. You can make a joint election to be treated as a qualified joint venture instead of a partnership. So that could be a little bit easier than, doing the partnership thing. This election, in most cases, won't increase the total tax owed on the joint return, but it does give each of you credit for Social Security earnings on which retirement benefits are based and medical and Medicare coverage if your rental income is subject to self-employment tax. So then the self-employment tax, as we saw with the Schedule C, if we have any of the income that's subject to the self-employment tax, then the federal tax would be kind of the same, whether you allocate it to one owner or two, between the married couple. But you want to be allocating properly the self-employment tax because that will affect the Social Security benefits that might be paid out to the two individuals at their retirement when they're receiving benefits from Social Security. So it's kind of important to make sure that you're allocating properly or thinking about the allocation of both spouses putting money into Social Security so that you can maximize or do the best to maximize the benefits that will be received by both spouses and make sure they're both getting the benefits that they should deserve, at the point in time of retirement. So rental real estate income generally isn't included in net earnings from self-employment subject to self-employment tax and is generally subject to passive activity limits. And that's going to be something that's going to usually be a little bit easier than, say, a Schedule C. And it's nice that the rental income then generally would not be subject to the self-employment tax in the same way as the Schedule C, unless you have certain circumstances we may talk about more in a future presentation. If you and your spouse filed a Form 1065 for the year prior to the election, the partnership terminates at the end of the tax year immediately preceding the year the election takes place. So in other words, if you had a partnership before and then you make the election, that's what they're talking about here. You had a partnership and now you're doing the election, so you don't have to do the partnership and then the K-1 type of thing. Limits on rental losses. Now remember, when you get to the losses on the rental income, that's where the IRS is going to be skeptical. And many people that have rental income will have basically losses. They're going to be taking the losses, and they could have substantial losses, and that's when you gotta make sure that you're applying out the rule, or that's when the IRS is going to impose restrictions or more restrictions related to the losses, because you can take the losses, or they're concerned about you taking the losses against other type of income. So if you have a loss from your rental real estate activity, 2 sets of rules may limit the amount of loss you can report on Schedule E. You must consider these rules in order shown below. Both are discussed in this section. So we have the at-risk rules. These rules are applied first if there is investment in your rental real estate activity for which you aren't at risk. So this applies only if the real property was placed in service after 1986. Then we have the passive activity limits. This is the second one. Generally, rental real estate activities are considered passive activities, and losses aren't deductible unless you have income from other passive activities to offset them. However, there are exceptions. So the passive activity rule basically would first mean, when they first implemented, I believe it was in this format, and then they basically made an adjustment. They basically said, hey, we're going to say all rental income is in essence passive. That means if you have a loss, we're not going to allow you to take the loss against other income, such as W-2 income. We're only going to allow you to take the losses against other passive income. So that means you would have to have passive income, like rental income possibly in the future, that you can write off against the losses. Then people that did the rental, that were basically rental professionals, they're saying, hey, you're kind of cheating us here because other businesses get to write off losses and you're not letting us write off the losses here. That doesn't seem fair. And the IRS basically then put in some of these exceptions to the passive activity rule. So the general passive activity rule, you can't write off the losses against other income, like active income, only against passive income, and then exceptions. So in addition to at-risk rules and passive activity limits, excess business loss rules apply to losses for all non-corporate trades or businesses. So again, they're skeptical of the losses. This loss limitation is figured using Form 461 after you complete Schedule E. So any limitation on your loss results from these rules will not be reflected on your Schedule E. Instead, it will be added to your income on Form 1040 or Form 1040-SR and treated as a net operating loss that must be carried forward and deducted in subsequent years. So then we have the at-risk rules. You may be subject to at-risk rules if you have a loss from an activity carried on as a trade or business for the production of income and amounts invested in the activity for which you aren't fully at risk. So you're not the one basically taking the risk here, and that's what they're looking into. Losses from holding real property other than mineral property placed in service before 1987 aren't subject to the at-risk rules. In most cases, any loss from an activity subject to the at-risk rules is allowed only to the extent the total amount you have at risk in the activity at the end of the tax year. You are considered at risk in an activity to the extent of cash and the adjusted basis of other property you contributed to the activity and certain amounts borrowed for use in the activities, the amount that you actually, put down on the activity. So any losses that is disallowed because the at-risk limit is treated as a deduction from the same activity in the next tax year. You can see publication 925. You can find that on the IRS website if you have questions about it for more information on the at-risk rules.